Good afternoon, everyone. This is Bob Dole, president of Solution Driven Wealth. Today is January 31st, 2023. Our concern for you and your family is always there. We're thinking of you and always concerned with your extended relationships. This is a far different year between 2022 and 2023. The beginning of 2022, we knew we had inflation on the horizon and that the Fed was going to dramatically have to raise rates to combat it, which they did eventually throughout the year. Members of the FOMC, the Federal Open Market Committee, have made comments recently that they will be data dependent and only raise rates as data supports that and really at the margin. So bottom line, most of the Fed's work was completed in 2022. Additionally, we have many of the companies in the S&P 500 trading at steep discounts from a bottoming that occurred last September. So those companies, in many cases, especially on the growth side of the ledger, are rallying significantly over the coming year. So with that economic backdrop in place, we look forward to a very bullish market, not only on the stock side or equity side of the markets, but also on the bond market. As this chart shows, recessions, when they occur, are a look in the rearview mirror. The market will have already understood when the recession is supposedly going to occur and is advanced in ahead of that point. So this chart from Capital Group is showing us that recessions will fall 6 to 8 months behind a market recovery. The other aspect with the data below this is look how many times a recession occurs typically. In this case, about 10 months. However, the expansion, meaning the production and the improvement of your portfolio, takes place over a 69-month period, nearly 6 times the amount of times your portfolio will be in a recessionary period. These are the year-to-date returns of the U.S. equity markets and U.S. fixed income markets. And boy, is this an improvement from last year. Last year, value or dividend-paying stocks, which are depicted here on the left-hand side, did outperform, albeit a negative number, versus the far right-hand side of this blue box, which were growth-oriented stocks. What's changed this year? Well, with lower valuations and the Fed really putting the kibosh on a lot of large rate increases here, that tends to be a very bullish sign for growth-oriented securities. Many of these companies are also reducing payroll. When you reduce payroll and benefit costs, that leads to a larger profit margin, and simply put, profit margins and profits and earnings from companies drive stock prices higher, and that is certainly going to be the circumstance as we move forward here. Value stocks didn't go down as much last year, but boy, growth stocks like Amazon were down 45 to 50% last year. So their growth targets and price targets are much, much higher than some of the value-oriented securities. That's one thing to take note from this slide. Additionally, the U.S. fixed income markets have improved dramatically. This tells you what investors think, how likely it is, rather, that the Fed will raise rates. The long-term bond for the first month of the year, total return is up a whopping 6%. That means that category of bonds includes any bonds with maturities above 10 years. So if the investing public and bond buyers felt that the Fed was going to raise rates, that would actually be a negative number. Investors are calling a bluff on the Fed. They don't think the Fed is going to raise rates any higher, and as a result, they're more comfortable buying long-term bonds. For the first time in 10 to 15 years, bonds have finally become a compelling asset class. We've been fighting the portfolio fight with really one hand tied behind our back, going all the way back to 2008 with a very low rate policy structure by the Fed, and really only incremental increases beginning on or about 2016 and later. When COVID hit, what did the Fed do? They dropped rates dramatically again. So bonds were not a compelling asset class. We knew this was happening, and it's why in many circumstances we reduced our bond exposure, because we knew last year was going to be a very, very challenging year, and we didn't want to be around for it, and we wanted to minimize the impact. Now that rates have moved higher, we feel that bonds can again become a compelling asset class for our clients. And we will be discussing those implications on your respective portfolios as we meet and do reviews throughout the course of the year. Another very bullish signal for investors, specifically in the U.S., is the reshoring of American supply chains, or supply chains back to the U.S. Why is this occurring? Well, a couple of reasons. We have a man named Mr. Putin overseas who really cut off the oil and energy supply to Europe. Many European countries were relying on as much as 60 to 70% of their energy needs to a communist country. We also look at China. As we know, many goods are manufactured in China. But China went through a zero COVID policy. And what does that mean? They wanted to simply eradicate COVID by shutting down their country. Imagine if you're a U.S. manufacturer and you have all of your supply chain needs being supplied by a Chinese company or manufacturing, and they simply make a decision one day of the week to say, we're done, we're shutting down. That means that your entire company's sales process is disrupted. American companies are pragmatic, they're efficient, and they will find a way to circumvent that situation. As a result, many companies are moving their supply chains back to the U.S. and diversifying them throughout Asia. So countries like Malaysia, South Korea, even Africa will benefit from these diversifications of supply chains, with much of the supply chains coming back to the U.S. for certainty and transportation and energy needs. That will actually be a huge windfall for American companies and businesses. We predicted that the midterm elections would occur and that the markets would rally actually before that, which historically is what they've always done. If you look at this chart, again, by Capital Group, this chart shows us that the 12 months following the midterm elections performance since 1950, a nearly 70-year history of time. So it's no coincidence that returns are higher after the 12 months of the midterms. Why is that? Well, we think it's not a coincidence, number one. Most probably it's due to the fact that new tax policy will not take place in the imminent future. This means that American businesses can make decisions on new product development, plant and equipment, strategies on rolling out of products, and strategies that are much longer term than just a 2-year cycle. We really don't think a new tax policy will be implemented for years. There is not the appetite for it due to polling that we saw during the midterms. So we really feel that this is a good guide to follow. This is the time that you want to be invested in the market. A 15.1% rate of return on average since 1950 in the 12 months following the midterms, compared to a 7.1% for all other years combined. That's a huge delta, and you want to take advantage of it in 2023. The composition of Congress does not matter. In fact, in this circumstance, we think it's beneficial. Having a split Congress means that no new tax policy will most likely be passed. It'll be very, very hard for Congress to agree on anything. We think this is good because it provides some level of certainty to the markets. And as we know, the equity markets do like certainty, and they will have that for the next number of years. We always appreciate the opportunity to help you, keep you educated with good, solid, sound, and prudent information. We look forward to communicating that to you throughout the rest of 2023. Have a great start to the year.